Good morning, everyone. This is Melissa Buckley again with the Multifamily Upgrade Program. Thanks for joining us today. I'm going to go ahead and get us started here just with a brief introduction of what we've got going on for the day. Our third in the four-part series of asset management webinars, Basics of Commercial Real Estate, is brought to you today by Tony Liu of Partner Energy. He's principal engineer and president at Partner Energy and is responsible for all of their operations and sales, overseeing their energy audits, benchmarking, energy models, and energy consulting services. Throughout his career, he's managed hundreds of projects across thousands of buildings nationwide. Tony began his career as an aerospace engineer with Northrop Grumman and later worked for Siemens Building Technologies, where he was responsible for customer acquisitions, engineering design, and estimating for building automation and controls, fire life safety, and security systems. After Tony graduated from business school, he worked as a senior associate director for a private equity firm in Los Angeles, California. And prior to founding Partner Energy, Tony was a sales and marketing manager for a local energy services company. So we are thrilled to have Tony presenting today. Before I turn it over to him, I just wanted to show you a couple things about using GoToWebinar. You'll find on your toolbar that there's a couple different boxes that give you the option to do a couple different things. You can minimize or expand it. If you've dialed in with your phone, you want to make sure you enter your audio PIN in the event that we have questions later on. You can also type questions into that questions box. And then the last thing I want to draw your attention to is the handouts toolbar. That we do have an Excel sheet that we have made available for you, which Tony's going to talk about in more detail. But you should be able to access it through that toolbar, and then we'll send it out again when we send out all of the presentation materials. So we'll take questions throughout as they come. Feel free to raise your hand or type a question in the box and we'll get to it. So with that, I'd like to go ahead and turn it over to you, Tony, to get us started.
Thank you, Melissa. Well, thank you everyone for joining us on this training session. Today we are doing the third part of a four-part series, and we'll be covering the Proforma process, real estate Proforma process. With that, let's just get started. So when I'm talking about this subject matter, I'm going to be talking in the context of acquisition and renovation project, meaning that the idea here is that
Tony, I think we lost you. You still there?
we're going to have you guys try your hand at creating a Proforma and doing a financial analysis on a property. There's some, and I'll review that toward the end. So, you know, I've been in this business for a while from both the real estate aspect and from the consulting aspect as an energy efficiency engineer, sustainability consultant. You know, one thing that I wanted to kind of clear up, what I find a lot of people find confusing is, you know, who are our clients? So the real estate company, they generally consist of a few teams within a single company, or it may be a group of companies that form a team to do these types of projects. So generally there's an acquisitions team. So the team here is responsible for identifying and underwriting new development or acquisition opportunities. They're the ones that's looking for the opportunity, identifying risks, and ultimately quantifying the financial return associated with the investment opportunity. So then there's the asset management team. So these guys focus on maximizing property value for investment purposes. So they're looking at how to reposition the asset, what are the market rents that they should try to lease for, what are the amenities and capital improvement items that they want to put into the asset so that it will maximize property value. Then there's the development team. So these folks are generally responsible for managing new construction projects or the rehabilitation of existing properties. And then you have property managers or property management, and these guys are responsible for the management of the day-to-day operations of the property. So when you're out there talking about your services, just be aware that if you're talking to the wrong person on the team, it may seem like the company's just interested in your service, and that may not be the case. You may not be talking to the right person, right? If you're talking to someone in the acquisition team, you're talking about energy efficiency, sustainability, improving asset performance, they're not that interested because they're really responsible for the bigger picture of finding a property to invest in. The right people to generally talk to, in my experience, is the asset management team, because they're the ones that are maximizing property value, and that's where we might have the most impact as consultants and engineers. So I hope that I was able to provide a little bit of context. Another piece, too, that gets somewhat confusing is who are all the parties involved in a real estate transaction. That says transition. Sorry, that's supposed to say transaction. So, the buyer, there's always a buyer and there's a seller. So a buyer can be any type of real estate company out there. But oftentimes there's also investment sales broker. So this is a person that's an intermediary between the buyer and the seller. It's if you bought or sold a house before, this is your real estate agent, right? They're the ones that are helping you look for a right building to buy, and they're giving you opportunities. So these guys are the intermediary between the buyer and the seller. But the buyer also needs financing, right? And they're generally looking for some type of loan, and there might even be an equity partner, right? So when you're looking at $40 million deals, $20 million deals, it's generally not one company or a series of banks giving you money. It's a lot of people that are creating a capital source. So an investment banker is generally is involved. An investment banker helps you identify various lenders and equity partners. And then there are also, property managers and building engineers. So these guys are usually tied to the property if it's under a transaction for the seller. So the building engineer could be a separate company, property manager could be a separate company. So again, I think the idea here is kind of understanding who you're talking to, right? And CBRE is an example here, and what's interesting is CBRE can wear all these hats, and they do. So it's good to be aware of what role and responsibility the person you're talking to has, so that you're communicating that your value statements correctly, and you're talking to the right decision maker. So when we look at a Proforma is just really kind of a statement of financial kind of current financial situation of a property. The first thing we generally look at is income and rents. So rent is kind of what we commonly understand is, how much money is each tenant in the building paying. So this concept is called average actual monthly rents. Kind of what are the in-place rents today? So it's pretty straightforward here. Basically, you look at the rent roll. Basically, you look at every single lease that's on there for the 1 bedroom, 1 bath, the 2 bedroom, 1 bath, the 2 bedroom, 2 bath, and you take the average of each unit type. So the average 1 bedroom, 1 bath in this instance is we're getting $902 per month in rent. The 2 bedroom, 1 bath is $1,056 a month in rent, and then the 2 bedroom, 2 bath is $1,111 per month in rent. So if we look at it, we get the average. If we multiply out the units and the average monthly rent, we get the average monthly rent, which is $331,968 at this property. So if you multiply that by 12, you get about $3.94 million in total rent. So the rent is obviously the biggest component of a building's income and the money coming into a building. But there are other ways for buildings to get and properties to get revenue. So RUBS. So ratio utility billing system. So when a building is master metered, meaning that when the owner pays all the utility bills, water bills, trash bills, they sometimes try to recoup some of these expenses. they institute a RUBS program, and the RUBS program is generally it's a bill back system to the tenants, and it's typically based upon number of units or square footage of the units, and then allows the owner to recoup some of the utility, water, and trash expenses that they're outlaying. So that's a way to recoup it. Sometimes they charge for parking, storage, and other income. It could be your washing machines, vendors. So these are other income sources. So in this particular example, we see about $4 million in rent, about $250,000 in other income sources, and we have a total gross potential rent of about $4.2 million. So that's all the revenue coming into this building. The next part of the pro forma is addressing vacancy, right? So when you have a 100, 200 unit building, you always have a few units that are vacant, right? These vacancies basically aren't deriving any rent, so you have to account for that. In this particular example, we have a 6.6% vacancy rate, and then that equals about $280,000 of lost revenue due to vacancy. Sometimes a property offers concessions in order to entice potential renters to come on site. So maybe you get a month or 2 month free rent, or maybe some type of gift card or giveaway. So these are generally called concessions, and there's about $262,000 of concessions in this property. In some apartment complexes, there is a model unit, so they'll show you a kind of a stage 1 bedroom, 1 bath, a stage 2 bedroom, 1 bath, and maybe they take a unit out for the office and leasing office. So these are units that are given up and you can't get rent, so there's a loss associated with that. So in this particular example, from all the vacancies, you're looking at about $530,000 of vacancy costs being attributed to these factors. So if you add total gross potential rent to the vacancy, what you come up with is effective gross income, or EGI. And this property has about $3.7 million in EGI. So next you have expenses. So real estate taxes. I've adjusted here. So in California, the real estate tax adjusts at time of during a transaction, meaning that Proposition 13, what that allows for is that we assess the property tax when we purchase the building, and every year that the property tax or the value can increase by 2%. So there's always a substantially high reassessed property tax value. So when you're looking at real estate, you just got to know that just because the seller was paying a low property tax, you for sure will be paying a higher property tax if the market's been increasing over time. Payroll, it's paying for staff. You have some facility staff on site. You have your leasing staff, maintenance staff, so on and so forth. There's landscaping, is a fee. Utilities, and we'll get into that in a little more detail later. Repairs and maintenance, right? So you're constantly repairing the roof. You have appliances, you have HVAC equipment that are breaking, and you need to repair them. Marketing, you got to spend money kind of telling the market that you're renting. Administrative costs, you have to pay for insurance. There's apartment turnover fees. When an apartment is vacated, generally property managers will paint and carpet and clean the units. There's a management fee for a third party. So property managers generally charge 3% of your revenue for their fees. Any capital reserves and for any capital expenditures or anything in the future that may break. So in this particular example, we have about $1.6 million in expenses. So when you subtract operating expenses from effective gross income, you come up with a term called NOI, or net operating income. So this is an important number. So net operating income. I'm going to take a little bit of pause here. Does anyone have any questions that they want to ask about what we covered so far?
Go ahead and raise your hand if you have a question. I don't see any. Or feel free to enter into the questions box.
Okay, I'll move on then. So I've talked about this a little bit. So there's multiple types of rent, right? So you got the in-place rent, and I talked about that. That's really looking at the current rent roll and seeing what are the in-place rents. And then there are asking rents. So it's what today the property is asking for a 1 bedroom, 2 bedroom, 1 bath, 3 bedroom. So what they're asking for today. And then there are economic / market rents. So this is what it's a generally accepted rental rate. So in our particular example, what we're trying to do is we're buying a older, worn property, and we're going to put money into it. We're going to rehab it, and then we're going to raise rents in order to create additional value, and then either hold it or sell it, right? So what we want to understand is what's the market rent for post-retrofit buildings or newer buildings. So that's what we're trying to do. We're trying to increase rents from in place, which is old and tired, to higher rents, which is the market rents or the economic rents of post-rehab properties. So how do we figure what those numbers are? So comparables. Right? So what we need are comparables. We need actual numbers from other buildings that are similar to what we are retrofitting to. So cost per month. Do you offer any concessions? And I've done this multiple times. Hey, I may have a roommate. What's a 2-bedroom, 1 bath cost? What's a 2-bedroom, 2 bath cost? So what you're trying to understand is what the market is asking for in rent for assets similar to yours on a post-retrofit comparison basis. So, but simply doing a market survey is not enough, right? The other piece that you have to adjust for are amenities, right? So, a lot of this is gut for a lot of people. Hey, this one had a washer dryer and this one had a washer dryer hookups. This one came with a refrigerator. This property didn't have a refrigerator. Or this one has a balcony. This one doesn't. This was air conditioning. So there's a whole long list of amenities that your property, which I'm going to start calling subject property, by the way, and your comparative property has or doesn't have. And in your analysis, what you want to do is make adjustments. And there's a dollar value associated with this oftentimes, right? In this particular example, if your property has a balcony, but the comparative property doesn't have a balcony, you can adjust your rent up by $15. If you have a enclosed parking garage, and the comparative property does not, you can increase your rent by $50. But if the comparative rent property has washer and dryers included in unit and the subject property does not, you need to decrease the adjustment by $40. So all these amenities need to be adjusted and analyzed. This way we get a real good feel for what we feel the adjusted value of the market or economic rents are. This is very similar to what appraisers do when they look at houses and try to evaluate houses. So, and then all this data is simply mapped out, right? So in my green bars with little pink middles, this is the average in-place rent. My blue bar with the blue dots, it's the market average. And then my red lines or red dots, it's the adjusted market average. So what we want to be able to, we want to see a delta between adjusted market average and our average in-place rents, right? So if the in-place rents equal adjusted market average, it makes 0 sense to invest in this asset because there's no upward movement and there's no way to create value in this asset by improving it or investing it. So we want to see a decent amount. So in our particular example, the 1-bedroom, 1-bath, the average actuals today are about $902. But upon doing our rental survey and doing our adjustments, we see that we can potentially raise rents to $1,000, $1,035. So every single one could be raised about $100 to about $150 per month. So that's a nice little bit of headroom that we've created by investing in this asset. So my total monthly rent would increase from $332,000 to about $380,000 $476,000. So again, from a monthly perspective, we're increasing the value by $40,000. So let's look at this from an annual perspective. So we've kind of gone through this already, but I want to compare it to the economic basis. So total rental income. So total rental income, I want to define that in a moment, and then I want to define underwritten rents versus economic rent. So underwritten is basically the example that we talked about originally, right? This is the unrehabbed as-is property that we're just going to buy, and we've done our due diligence, and this is what's there now. The economic rent, or the economic column, is, hey, this is where we think we can bring this to. After we invest in it, retrofit it, we think we can raise rents, and this is what the Proforma will look like post-renovation. So total rental income, right? So this is what's potential, right? So what we do is underwritten, this is what the potential is. So $4.5 million, which is really 350 times 12. That's our total potential rent. But we only have $3.9 million today, so we have a loss to lease of $532,000. So we are missing $532,000 of value as compared to what the economic is, right? If we look at the economic column, assume we get to the post-renovation condition, we're not missing anything, right? We're actually getting that total rent. That's what our pro forma will be. So I just wanted to identify that difference there. And then we looked at, all the various other income sources. So, upon further research, we think that we can get some additional garage income, we get some storage income, maybe we can recoup more of the utility expenses. So what we're seeing is that our gross potential rents increased from $4.2 million to about $4.8 million. Vacancy, we feel like we can get the apartment loss vacancy down. And because we're rehabbing it, we're making it nice, we're putting the best finishes out there, we're putting new appliances, granite countertops, fresh carpet, maybe even hardwood floors, that we don't need to expend as much concessions as we did as before, right? It looks nice, it's new, so that we can reduce our concessions amount. So according to this analysis, we're reducing our total vacancy from $534,000 a year down to $345,000. So what that means is that I'm increasing my effective gross income from $3.7 million up to about $4.5 million. So an $800,000 increase in value. So I got to look at my expenses, right? So real estate taxes, really nothing changes there. Payroll, you know what? They were under managing it, so we had to add more people, so we're actually going to increase payroll fees. Landscaping, about the same. Utilities, it's about the same, but we're going to invest in some things that we're going to talk about a little bit later. Repair and maintenance, we're investing a lot of things, so we're going to reduce that amount. Marketing, about the same. Administrative, about the same. So we're actually decreasing expenses slightly, about $70,000. But ultimately what we care about is that our net income has increased from today's pro forma to our economic pro forma by about $860,000. So that's a significant increase.
Hey, Tony.
Yes.
We did have a question come in a couple slides ago that might be okay to take here if that's okay.
Sure.
And it is, could you talk about maybe some of the best ways to estimate maintenance and repair costs?
I can. When we were doing R&M, it was usually, it depends upon the age of the facility, so it's kind of a tough thing, right? Turnover fees, R&M, and reserves, they're somewhat, reserves, people maybe put $100, $200 a unit per year. Apartment turnover maybe a little less. R&M is a harder one to guess, because it really depends on the condition and age of the asset, right? If you have a 2014 building, your R&M fees are should be quite low. But then when you are, when you have a 1970s build and if you're acquiring it and the previous owner didn't maintain it well, that number can be huge. So really, to get a good estimate of that is you should order a physical needs assessment, a P&A or property condition report. And what this does is an engineer comes out and they will assess the mechanical systems, the building envelope, just basically the entire physical structure. It'll talk about the condition, existing conditions, and then what they'll do is they'll put together a reserve table that's saying that, hey, short-term repairs, meaning stuff that, it's broken today, you need to replace it, and it's cost you $1 million. And then they'll give you a long-term reserve table that basically says that over the next 10, 20, 30 years, really depending upon your loan term, this is when we anticipate you needing to replace various systems or equipment within the building. So that's the best way to estimate what the repair and maintenance costs are. It's getting a physical needs assessment.
Thanks.
So let's change topics a little bit. Let's talk about real estate valuation, right? So we've gone through these Proforma. So we know what the NOI is, and we know what the cash flows are that a building are. So there are really three methods, and I think this was somewhat covered in a previous presentation. So I won't go into as much detail, but there's a cap rate method, there's a discounted cash flow method, and then there's the replacement value method. So the cap rate method is it's kind of like an annuity, right? So if you invest in something, let's just say you put $1,000 in the bank and you get a 1% return, you're going to end up with $10 a month in return, right? So $1,000 is your investment, 1% is your return, and then each month you get $10, right? So real estate can be equated in the same way. Your cap rate is your return. So in my little easy example, if I want to see how much I need to invest to get $10 at a 1% return rate, I take $10 divided by 1% and I get $1,000. So the same thing can be said about real estate. So NOI is the amount you're getting, so that's equal to $10. So in this case, it's $2.9 million. Your cap rate is what the interest rate is what your return rate is. So that's in this instance is 5%. So your value is $2.9 million divided by your cap rate, and it's going to be $58.26 million in this instance, right? So it's NOI divided by cap rate equals real estate value. So how do you figure out what cap rates are? Well, again, it's comparables. So what you need to do is you need to do some market research. CoStar is a tool that most CoStar is somewhat of a national database where they collect data about buildings that have transacted in various places around the country. And what they generally provide is information about sales price. They provide information about cost per square foot, and then they have information about what their net operating income was. So as we're doing this research through CoStar and other sources, we can find that, hey, in this market, the NOI is about 5.6%. So, coming out and just guessing at these things is not the right way. It's really getting comps, right? Comps for rent, comps for sales, and the more recent, the better, because times change. If you get comps from 5 years ago, it doesn't really have a bearing on what values are today. Cap rates change over time, right? In heated markets, cap rates compress, meaning they get lower and lower and lower. In bad markets, cap rates increase, right? Why does it go up and down? Well, it's risk, right? In hot markets, everybody wants to be in real estate, so the risk gets lower and lower and lower, and with lower risk, you get lower returns. In bad times, cap rates increase because you don't want to invest in real estate, therefore you need to have higher returns in order to entice people to purchase real estate. So I want you guys to understand that NOI cap rate analysis, because that's really popular and really useful term in terms of real estate finance. And then there's discounted cash flow. Somehow I skipped a slide there, but discounted cash flow really means you take your NOI, you consider all the potential rent growth. Maybe you bump rents up 2-3% every year. Then you take the present value of your cash flow through time, and if you have a positive number, that means that it's a reasonable investment based upon a subject discount rate. I'll get into that a little bit later about NPV and discount cash flow, and I think you guys covered it before as well. And then you have replacement value, right? So it's basically how much it costs to build this property from scratch, right? You have site costs, how much the land is, how much it costs to entitle it, how much it costs to build it, and how much it costs to kind of design and develop it as well. So that's the third way is, okay, what's the replacement value of this asset? For what we're going to go through is we're going to really focus on cap rate methodology. So another financial return number is called internal rate of return. It's a percentage rate earned on each dollar invested for each period it is invested. So what this is good for is that it allows you to compare different investment amounts, right? Oh, I'm getting a 12% return on this investment, and I'm getting a 2% return on that investment. So 12 kind of is higher than 2, so you think the former is better than the latter. The weakness here is that it doesn't take into account the quantity investment, right? A 2% investment of $10 million versus a 12% return on a $2 investment. It's different, right? You don't get that sense for the order of magnitude, but you certainly get the sense for the return of percentage. So there's some weaknesses there. So net present cash flow. So it's a means by when an investor measures whether the investment is achieving a certain target yield or discount rate at a given initial investment. So what it basically says that is if you anticipate or you want a let's just say 11% return on capital or return on investment, if your net present value of all your cash flow is equal to 0, that means that you achieved your 11%. If your net present value is greater than 0, that means you're doing better than 11%. If you're doing less, it means that you're doing worse, right? So NPV of 0 just says that, hey, you're achieving your discount rate. So in Excel, what you have to do is, and there's a lot of people make a mistake, right? This is NPV formula. NPV, open parentheses, basically your next character you put in there is your discount rate, and then you put in your stream of revenue or a stream of cash flow. That calculates your net present value. But you want to add that to your purchase price. What you don't want to do is take the NPV and include your purchase price and your future stream of cash flow. So that's a wrong way of calculating. So NPV is calculated by taking the purchase price, which is a negative number, and then the NPV of the future cash flow is how you should be calculating NPV in Excel. So let's look at this scenario here. So we have a source and uses of capital. So this is another common financial way of looking at things. So the uses are basically, okay, this is everything I'm going to have to spend to make this investment work, right? So I'm going to buy the building, I'm going to renovate it, I got to pay a bunch of brokers, I'm going to pay a sales broker, investment broker, there's going to be closing costs, there's going to be insurance, taxes, all that stuff. So in this example, my uses are purchase price about $41 million. I'm going to renovate it. I'm going to spend about $2.1 million on renovations. I'm going to pay brokers and fees of a lot of money, and there's closing costs. So the total amount of money I'm going to need is $44.9 million. So in this all-cash purchase, somehow I have $44.9 million in my pocket, so I'm going to buy cash for everything. So in my cash flow model, year 0, I'm going to purchase it for $44.9 million, right? And then based upon my pro forma, my year 1, 2, 3, 4, 5, I'm going to get $2.9 million in return, right? So what this example doesn't account for is any increase in the rent that you might want to do. So we're just assuming that, hey, rent growth is 0. Oftentimes people underwrite 2 or 3 or 4 or 5% rent growth depending upon how hot the market is. And how do you figure out what the market rent growth is? Again, doing comps and doing market studies and doing supply and demand studies to show that, okay, if there's a shortage of housing, we can assume rent growth will be higher. If there's a glut of housing, you'll assume rent growth is lower. So you're going to do a lot of market analysis to figure out that rent growth can be. So if we look at the stream of cash flow, what we have is negative $44.9 million, year 0, so that's for the purchase. Year 1, 2, 3, 4, and 5 are getting $2.9 million in NOI. And then year 5, I'm selling it. right? I've added value. I'm going to sell it. So $2.9 million based upon a 5% cap rate. That means I can sell it for $48.5 million. So if I take my internal rate of return, I'm getting a 7.9% return on my money. So that's not bad. If I look at the MPV, I have $10.3 million based upon a discount rate of 3%. So I'm beating 3%. So it beats putting it into a bank. Even bank accounts today have a discount rate of probably 1%. So it's a reasonable investment. Anybody have any questions at this point in time?
No questions that I see.
Okay. So let's go into leverage and debt. So for those of us who've been fortunate enough to buy a house, we get debt. We get a loan from a bank. So typically there are a few types of loans. There's an amortizing loan. What the amortizing loan is, it's where the principal of the loan is paid down over the life of the loan or amortized according to the amortization schedule, typically consisting of equal payments. So, you get a loan from the bank. It's 500. Let's just say it's $2,000 a month for the next 30 years, right? And over 30 years, you're paying that loan back and you're paying the interest back. So at the end of 30 years, you own nothing and you own your house. There's another scenario where you have an interest-only loan. So interest-only is just what it is. You only pay the interest. So you have a 4% interest-only loan and you have $500,000 mortgage. Every single year, you're paying $20,000 in interest. Term, that's a period of time where the loan agreement is in force. The interest rate, this is the rate of interest charged on the mortgage, so it's 4% interest rate, 3% interest rate. APR is an interesting concept here. It's the actual annual rate. What this builds in is if any other fees, right? If the broker has a fee that they add, there's a buy down rate for, let's just say it's it's a 5%, but I could buy it down if I pay $10,000 to 4% to 3.75. So APR is the actual full interest rate you're paying for that loan. So it's a better comparison than actual interest rates because it accounts for other fees that are associated with the loan. Loan sizing. So for residential purposes, people generally, hey, you can borrow 80%, right? So 80% LTV, 80% loan to value is generally what we do in the residential side. But when they're underwriting you, meaning they're trying to figure out if you're a good risk, you're a good risk for this loan, they look at other things. In the commercial world, what they look at is debt service coverage ratio, right? So that's the ratio of available cash flow to pay the debt obligation. So I'll get into examples. So in Excel, so a monthly payment is PMT. It's you take the APR or your interest rate, divide that by 12 because it's monthly. 12 is for monthly. You take the term of the loan, typically 30. You multiply that by 12, so that's 360, and then you put comma your loan amount, and that gives you your monthly payment. So if I have a loan amount of $35.9 million, a 30-year term, of 4% interest rate, my annual loan payment would be $2 million, about $2 million. So debt service coverage ratio. So in this particular example, right, I have a real estate value of $44.9 million. I have an 80% LTV, so I'm going to borrow $35.9 million. Based upon my research and my Proforma, I'm going to have $2.9 million NOI. So what that equals a loan payment of about $2 million. So my debt service coverage ratio, which is my NOI divided by my annual loan payment, is about 1.4. Generally, banks want greater than 1.25 for a debt service coverage ratio, and they generally won't go above 80% LTV. So in this particular case, I'll probably be able to borrow the money. Right, I have enough cash flow coming from property that it covers it at a 1.4 ratio, and then I only need 80% LTV, which is $35 million. So let's look at that pro forma, right? In this instance, right, so I have my $44.9 million total uses, right, so nothing changes there. And then I'm getting 80% LTV. That means my debt is $35.9 million. And then I have equity. That means I need to come up with about $9 million out of pocket. That's hard too. So there's equity providers out there. I kind of mentioned that earlier. I'm not going to go into the details, but you can find other people to co-invest it with you to buy this property, and there's 1,000 different ways to do that as well. So with a $35.9 million loan, 4% interest rate, amortization period of 30 years, my annual payment is about $2 million. So let's look at this cash flow now. So my equity now, my outlay before it was $44.9 million. I didn't have that. I had $9 million. So I got a bank loan. So I pay about $9 million in equity. So each year I get the same NOI, right? I get $2.9 million, $2.9 million. In year 5, I'm still selling it for $58 million. That's $2.9 million at a 5% cap rate. So my cash flow is a little bit different now. Is a little bit different in that I have to, I outlay 9, and then I get 2.9 every year. Then I get $61 million, but I have debt on it now, right? So every year I'm paying $2 million in debt. So the debt service coverage ratio is 1.4, right? It's 2.9 divided by 2. But then I also have to repay a loan, right? So in year 5, I have to repay a loan of $32 million. So my cash flow after debt service is I have an initial outlay of $9 million, and each month I'm getting about $834,000, and at the end of 5 years I'm getting $26.6 million. So if I look at my IRR and NPV, my IRR has been juiced up to 30%. My NPV is $17 million now at a 3% discount rate. So leverage allows us to get a better return, right? So again, it doesn't talk about you get less cash in general back, but the amount of internal rate of return is greater. So this is, in general, a better investment for people because they have a higher return and they're able to get more return based upon less money they do invest. Any questions? Okay. So I'm going to talk about the utility bills, right? So we had an energy audit. So we had a current utility cost of about $251,000. The energy audit was ordered, and it said, okay, you need to install high-efficiency lights, high-efficiency boilers, high-efficiency HVAC equipment. We know that the install cost is about $225,000. There's some rebates, about $40,000. The net install is $184,000, and then the annual cost savings is $35,000. And the payback period is 6.3 years. And 0.8x multiple on my investment. That's pretty good, right? And as part of a rehab project, the other benefit is, hey, you're adding more value to the property. You don't have to do these replacements in the future. You're doing it today. You're adding additional value. So this makes sense. This is a nice argument to make for people that are simply looking at simple payback as a metric, whether or not to do capital investments in energy efficiency. I'm going to talk about some new exciting things on the financial market side, but I will take a pause for any questions.
No questions.
Okay. So, in this day and age, I've been doing this for about 8 years, and I've been providing energy efficiency and sustainability consulting services for 8 years. And I think today the market has fundamentally changed. It's changed in the fact that when I first started this business, I was knocking on doors saying, hey, I would like to do some energy studies and engineering work for you to help you save money at your property. Right? I can help you, increase your value of your initial investment by 4x, and it could be a 20% return. All these things seem great. And that was met with limited success, right? It's hard knocking on doors and saying you can help them save money because people, it's somewhat of a small number, and they really need to be interested to take you up on it. But now the lending, agency lending in general for multifamily especially, is pivoting toward energy efficiency and sustainability. What it's doing is increasing attention to energy efficiency and sustainability, and it's really part of the norm and not the exception anymore. And it's somewhat profound because it's no longer the tail wagging the dog and, hey, I want you to do a small piece to replace a couple of lights and boilers. Now, energy efficiency is part of the whole building capitalization. So Fannie Mae, Freddie Mac, HUD, which is Housing Urban Development, all of these organizations have loans. They provide debt to multifamily market, and they probably make up about 50% of the market. So this is significant. HUD has their mortgage insurance premium reduction. Fannie Mae has their green financing, and Freddie Mac has their Green Advantage program. So what are the benefits here? First, you get a reduction in borrowing costs, or preferred pricing, or advantage pricing, right? All this really means is, hey, your interest rate is a 5% today. If you go green, quote unquote, go green, we'll give you up to 40 basis point reduction, or 0.4% reduction interest rate. So it goes from 5 to 4.6%. So that's the number one, right? That's a significant savings, and I'll quantify that a little bit later. Oftentimes, these programs will allow you to underwrite NOI and value, meaning that if through your energy audit you identify cost savings, they'll let you underwrite the cost savings. Kind of what we talked about earlier is, hey, if I'm able to reduce my energy cost by $20,000, I'll be able to adjust my NOI by $20,000. You get additional loan proceeds. So with the higher NOI, all this is coming together now, right? With a higher NOI, I'm able to borrow more money because my value is greater. And then oftentimes they'll pay for the cost of the study as well. But there are other benefits. These are the traditional benefits we talk about, right? The reduced operating maintenance costs because you have newer equipment. Because you're investing in your asset, you'll increase or retain property value, and you'll certainly protect yourself against fluctuations in energy and water costs as the cost for consumption increases. And then finally, you also get happier tenants. You're going to improve indoor air quality and their comfort as well. So what are the requirements? Again, this thing is really involved, but I kind of want to give a high-level understanding to what these programs require. So Freddie Mac, what they're asking for is you have to reduce owner-paid energy or water use by 15%, and you need to get a green assessment. So it's kind of a level 1 energy audit in order to obtain that. Or if you already have a green certification, you get to qualify for Freddie Mac's benefits. Fannie Mae is looking at it a little bit differently. So they want you to reduce whole building energy or water use by 20%, and this requires a high-performance building module or an ASHRAE Level 2 audit. And the other path to compliance is getting a green certification. And then HUD, they actually want you to get a green certification and maintain an Energy Star score of 75 and above, and then also conduct an ASHRAE Level 2 energy audit if required. So again, this is just very high level what they're asking for. I want to throw this in here because this is, Energy Star is something all you guys should be familiar with by now. Energy Star Portfolio Manager, again, it's a rating system for commercial buildings, and recently they made a rating system for multifamily buildings. What it is, based upon building physical characteristics, geography, location, and energy use. It provides you a score. The score is a 1 to 100. And then and it's quartiles. If you score 75, that means you're more efficient than 75% of the building data set. If you score 30, that means 70% of the buildings in the data set is more efficient than yours. So this is something to just be familiar with. And all the programs I talked about, Fannie, Freddie, and HUD, they do have some Energy Star reporting requirements. So what's this preferred pricing? This makes a lot more sense, right? In my previous examples, I'm saving, $20,000 or something in energy costs, so which is good. But let's look at this example, right? So if I get a 30 basis points or 0.3% preferred pricing, in this example, it's a $30 million loan, 5% interest rate, 30-year term. My annual payment is $1.9. But if I went green, I was able to reduce my annual payment to $1.867 million. So I'm saving $65,000 annually. or over a 30-year loan period, I'm saving $2 million. This moves the needle. This moves the needle more than saving $10, $20, $30,000 on utility expenses. So in combination of both, this really makes sense. So this is why we feel like this is kind of a big deal here. And you know, in this example, I won't go into so much detail because we're running a little bit out of time here. All this is saying that you get to underwrite. You get to underwrite a portion of your identified savings, which is a nice feature as well. So without the green rewards, you can basically only borrow $12.99 million. With the green rewards and identified about $47,000 of energy savings, you get to underwrite 75% of that to your NOI. And based upon that, you get to borrow an additional $700,000. So it allows you to borrow more. So the two primary benefits here is, A, you get to reduce your borrowing costs. B, you get to borrow more money. And that's the big significant part about agency lending and green products. I'm going to skip this last thing. This is just kind of talks about collateral, cash flow, and credit. I do want to go over the assignment a little bit before we conclude, but I will pause for questions. Does anyone have any questions?
Nope. Go ahead.
Okay, so I have a homework assignment for everyone here. I'm pulling up Excel. Can you guys see my new screen?
Yes, we can see it.
Okay, so what we're going to try to do is recreate a pro forma, right? So there's an Excel model here, and there's a bunch of questions here, and I'd like you to answer these questions, and you can submit them back to me, and we can review them and talk about them. So in this one slide, there's rents, right? So basically, I pre-filled in this particular example is a 1-bedroom, 1-bath, and a 2-bedroom, 2-bath, and I gave you average actual rents. What I'd like you to do is for you to calculate total monthly rent and total annual rent based upon this information. And then I want you to do a market analysis, right? So I've given you rent comps, right? So this analysis is done, and these are some rent comps of similar units. So I want you to tell me what the economic rents would be, assuming that these are comparable properties. And then next slide, I have a pro forma. I want you to do the underwritten pro forma and the economic pro forma based on the concepts that we covered here. So tell me what total rental income is, actual rents, loss to lease, total gross potential rent, effective rent, and net operating income. Let's go to utilities. So I want you to calculate what utility savings is, assuming that we do everything in the energy audit and the rehab. So tell me what the projected cap rate is. So I give you sales comps here. So based upon these sales comps, I'd like you to tell me what the cap rate you would put into there. Enter the value of these cost savings. Let's see what else we have here. We have some source of uses here. So tell me what 80%, 20% debt and equity are. And then I'd like you to do a financial analysis. Kind of what we covered there. So calculate unlevered and levered analysis based upon this pro forma. Are there any questions?
So Tony, you'd like folks to send these directly to you. Is that right?
Sure.
Okay. So when we send out the materials from the training today, we'll have both a link to the recording from the webinar, and also the slides will include your contact information and this document.
Yep. So that concludes this session. I know there's a lot of dense material here, so feel free to kind of take some time, go through the slides, and you can shoot me any questions you may have, and look forward to looking for some of the homework assignments. And again, hope you found this beneficial and helpful, and thank you for joining me today. Thank you, Tony, for delivering such valuable information. And we have just a couple minutes if anyone has a last-minute question that they want to ask of Tony while he's here on the line. All right. So as I said, we'll get the information out probably by tomorrow morning so that you can get started on this, and we'll go from there. And stay tuned also for the next announcement for the 4th part of this webinar series. So thanks again, Tony, and thanks everyone for joining today.
Bye-bye.